Listen, if you don't know exactly where institutions are setting their liquidity traps, well, there is a really good chance you are the liquidity. It's a harsh truth, right? But you've got to accept it. The financial markets don't just move randomly. Market makers, the big institutions behind the scenes, they absolutely require massive amounts of liquidity to execute their orders. And retail traders, they consistently lose money at the exact same repeating locations. Why? Because they're blindly trading straight into institutional traps. So, let's get into it. Today, we're unpacking the institutional trap map. We'll be breaking down the 6 core liquidity traps market makers use, exactly as they're laid out in our source material. And, more importantly, we're going to show you how to actually spot these traps on live CFD charts, so you can start exploiting them instead of falling victim to them. I really want you to start treating the market like a battlefield map. You know that line you, as a retail trader, look at and think, oh, that's strong support, or that's solid resistance. Well, the market makers see something completely different. To them, that line is literally a stop-loss buffet. They know exactly where the retail armies are hiding their stops, and they engineer very precise maneuvers to go out and trigger them. All right, let's jump right into trap number 1, liquidity pools. If there is a peak point for retail frustration, it happens right here. Retail traders get totally lured into stacking their orders, 100% convinced a price level is safe. You can actually spot this so easily on a live chart, say gold on the 1-hour time frame. You'll see price repeatedly tap the exact same area, 3, 4, maybe even 5 times. Retail sees this and thinks, wow, strong support, I gotta buy in. And they stack their stop losses right below it. But look closely at the details. The volume is thin, the wicks are long. The market maker is just quietly gathering up all those stop losses, getting ready for a sudden, violent sweep to clear everyone out before instantly reversing in the true direction. So, how do we actually survive this? The golden rule here is never, ever enter right at the zone where retail places their stop losses. Instead, you wait. You want to see the market maker execute that liquidity sweep first. Once that sweep happens, you look for a break of structure, a BOS, to confirm the true direction. Only then do you execute your entry on the pullback. Basically, you want to enter after the trap has already been sprung. Moving right along to trap number 2, the fake breakout zone. Listen, if you're a breakout trader, you are quite literally breakfast for the institutions. Breakout trading is one of the most common retail strategies out there, which makes it incredibly easy to exploit. To stop being the main course, you've got to memorize these 4 warning signs of a fake breakout. First up, check the candle body. If it breaks out weekly, say just $5 to $10 on gold, and leaves long wicks, that is highly suspect. Second, there's just no follow-through. The price just stalls out. Third, you get an instant reverse engulfing candle that wipes out the breakout within 1 to 3 candles. And fourth, and this is absolutely critical, it happens during the Asian session. Market makers love using this low volume period to induce FOMO, trigger buy stops, liquidate traders, and then send the price flying the other way. Your survival rules for this one are pretty straightforward. Just completely avoid trading breakouts during the Asian session. Skip them entirely, no exceptions. If you really want to trade a breakout, it absolutely must have confirmed strong momentum and volume behind it. Otherwise, always focus on trading the retest instead of chasing that initial burst of price. That brings us to trap number 3, small range compression. This one is like the eerie silence right before a devastating storm. Imagine US 30, or any major pair really, compressing into a tiny, suffocating 50 to 80 pip range. Volume just completely dries up, retail traders get bored, they absolutely hate sitting on their hands, right? So they start taking heavy, over-leveraged positions right inside this tight little range just to feel some action. But the market maker? They are endlessly patient. They are just chilling, waiting for enough retail liquidity to build up on both sides so they can tear that range apart with a massive 300 to 400 pip breakout candle. You really have 2 practical choices to survive this specific trap. Choice 1, stay completely out of the range. Grab a coffee, go for a walk, do absolutely nothing while the market compresses. Choice 2, wait patiently to trade the actual range tear. Keep in mind, the longer and more boring the compression is, the more violent the eventual explosion is going to be. Never trade inside the box. Just wait for the box to explode. All right, next up is trap number 4, the mid-session reversal. This is a classic. It's a highly effective weapon that heavily plays on the timing of the European and US sessions. You see this a lot on pairs like EUR-USD. Let's walk through the daily cycle. So during the Asian session, a slow initial direction gets established. Then London opens up. The European session grabs that direction and pushes it incredibly hard. And this is totally deliberate. It's designed to build massive retail FOMO. Everyone jumps in, convinced a huge trend day is unfolding. But then, New York opens. The US session kicks off with this massive engulfing reversal that completely crushes the European trend, stopping everyone out. So how do we apply this? The rule here is simple, but honestly, it's a lifesaver. If the European session looks exactly like the Asian session and just keeps pushing in the exact same direction, stay patient. Do not enter. Instead, keep your eyes glued to the New York reversal window. If the US session opens with an engulfing reversal, you know for sure that the prior trend is about 90% dead and the real institutional shift just happened. Which leads us to trap number 5, the news liquidity spike. Okay, we really need to clear up a massive misconception here. Economic news does not actually move the market. Market makers do. The news is just a convenient catalyst they use to execute their traps. If you watch a live chart during major news like NFP or CPI, you'll see this play out perfectly. The market maker action features these massive 200 to 500 pip sweep candles that violently spike up and then just as violently spike right back down. They are sweeping liquidity on both sides of the market. Trying to use a wide stop loss here? Utterly useless. They will hunt it down. And then, ironically enough, the price usually settles right back exactly where it started. The actionable survival rule for this news spike trap is completely uncompromising. Absolutely no trading 30 minutes before and 30 minutes after a major news release. You just have to let the market finish its chaotic sweeps and return to reality before you even think about looking for a true directional setup. And finally, we've reached trap number 6, the premium and discount trick. This is such a brilliant trap because it preys entirely on human psychology and how retail traders perceive price extremes. Think about how retail operates on a NASDAQ chart, for instance. Price violently breaks previous highs, it looks incredibly strong, so retail buys exactly at the top, the premium. Or, on the flip side, price crashes, it looks incredibly weak, so they sell right at the bottom, the discount. But institutional logic? It's the exact opposite. Smart money is taking the other side of your trade. They are selling when you buy the premium, and they are buying when you panic sell the discount. To beat this trick, you have to always map out your premium and discount arrays before you even think about placing a trade. Never, ever buy in a premium zone, and never sell in a discount zone. Most importantly, make sure the market maker has actually swept the liquidity in these zones before you even consider executing your entry. Ultimately, CFD charts really aren't that difficult to read once you start looking at them from an institutional perspective. Most traders fail simply because they don't understand where institutions are out hunting for liquidity. Remember this, the place that feels the safest to retail traders is almost always exactly where smart money is preparing to take liquidity. If you want more explainer content diving deep into institutional smart money concepts, be sure to subscribe, and you can find some more great resources linked down in the pinned comment. But before you go and open your next trade, I want you to ask yourself one thing. Are you the one setting the trap, or are you the liquidity?